So Cyprium Metals, our principal asset is the Nifty Copper Complex. Nifty is a well-known prolific producer in Western Australia. And over the next 9 minutes, 45 seconds, I'll tell you a little bit more about what we're doing. It's a story of redemption. It's a story of price dislocation. And in my professional opinion, one of the most spectacular opportunities on the ASX today. So if I could give you just 3 points. Okay, the first is being in copper and being in Western Australia is very exciting, but the inherent benefit that comes with being a past producer is immense. We have so much information historically and so much left within the next stage of Nifty's life that gives us a tremendous speed to market and ability to create a powerful company. This is a mine that was discovered in 1993. It had a period where it operated as a cathode producer. It had a period where it operated as a concentrate producer. It then went through a troubled past. I like to call it its midlife crisis. And so as you'll see today, we're setting really simple plans to take it through the duration of its life. And those plans, we're rapidly executing them. If you just look at what we've done over the last year, it's been a lot of forward effort and momentum through the thing. Finally, we've been moving so hard and so fast in repositioning this asset. I think that the market has missed it. At the moment, we have only one equity research analyst covering us. We're just now turning from being inward focused on the company to outward focus on talking about our plans. And so this is really that moment in time where you'll see where the company is headed. And that, to me, is some of what helps present that asymmetric risk reward opportunity. A little bit about our company. So first, the Nifty Copper Complex, for those of you that aren't familiar with it, it's a sedimentary copper project. It sits about 5 hours by road from Port Hedland in Western Australia. We have a second project, Maroochydore, that is about 80 kilometers away by exploration road. Together, that's about 2.5 million tons of contained copper within resource. It's a huge amount of copper. In fact, it's one of the largest pure copper deposits not owned by BHP. And when you look at the comps, it stacks right up there with very large companies. So our company, we have about $100 million enterprise value. We're trading at roughly $45 to $50 million market cap. We're carrying some of that troubled past with us today. We have the original purchase note in the form of the convertible notes, $36 million to Metals X, and then we also have a loan to our partner Glencore, which is a senior secured loan that sits on our balance sheet as well. And so over the past little while, as we've been repacking the company and developing our forward plans, this balance sheet has been weighing not only on board and management, but I think on investors as well. So what we'll talk about is a plan to reestablish cash flow quickly, accretively to shareholders, and take us through to the next step of the journey. Also, you'll notice that our shareholders right now, from the turbulent past, there aren't a lot of ASX shareholders here. And again, where we have been with the company and repositioning it, we're just now getting back and talking to folks. We have strong support from our large shareholders, including myself. I'm a cash investor and own 7% of the company, and the board and management own just under 12%. So let's talk about Nifty. As I said, it's a sedimentary copper deposit. What that means is that the copper generally is laterally continuous and kind of where you expect it to be. Over its life, there was a shallow open pit that produced 220,000 tons of copper, and then again, a very deep, high-grade underground that produced about 500 million tons of copper. 500,000 tons, excuse me, of copper. And what happened is by going down dip and going for that high undergrade area, there's a tremendous resource that's left, in place. And it's about approximately halfway through its life. So being halfway through its life, you can see on the top left-hand side a cross-section. So we can go back, there's about 80 million tons at 0.9% copper. That puts it at the top end of, probably top quartile of where people are trying to develop projects today. It's a high revenue per ton copper deposit, and there's about 80 million tons of it in resource. Then the second large asset we have an above ground resource sitting next to an SX-EW plant. Contains about 90,000 tons of residual copper that hasn't been leached in the first efforts. And so we're taking a look at that as our short-term cash flow option. The third thing, as a historic producer, if you can see up above, camp, airstrip, power plants, mess, swimming pool, although I did just hold off on refurbishing the swimming pool until we're into cash flow. But we have everything that you would expect, and when you show up and you walk around and you look at it, it looks like a mine, it feels like a mine, our approvals are up to snuff and in the mining status, and that allows us to move very quickly. So let's talk about that above ground resource. Okay, so we have 90,000 tons sitting in the heap leach. We released last year a mineral resource estimate. I'd encourage you to look at it. It's the first time in 10 years that somebody had actually gone through and racked and stacked what's left in the heap leach. What we've designed is a plan that is effectively as accretive as possible. It's not let's go get the most copper out of this as possible. It's let's make the most money for shareholders. And so what we're doing is we're turning over the heap leach in place. We'll hit it again with acid and expect low recovery. And to refurbish the plant that's on site, again, the question is, what's the capital bill look like? In our pre-feasibility in November, it's about $30 million to reestablish the ability to plate copper at the plant, plus another $10 to $15 million of capitalized operating costs. So this is about a $40-ish million project for us to reestablish production. What does that look like? Yeah, okay, so behind me, what you see, and hopefully you can get a sense of it, the dark blue stack charts on the top is revenue, and on the bottom is free cash flow. And what you see is the dark blue bars are $4.25 copper and 71-cent FX. Well, we're actually quite a long way away from that today. And the aqua bars are the forward curve. But what it tells us is that on a 4-year reserve life, what we see in terms of a $40 million commitment is we're gonna make about 40, maybe 50, depending on where the macros are and how well we execute, but $40, $50 million a year of cash flow. That's strategically important to us. That stabilizes our company. It allows us to address our balance sheet. It allows us also, importantly, to walk before we run. We have a partnership with McMahon Holdings, which is a 9,000 person contract miner based out of Western Australia. They operate surface mines and processing plants of this nature and scale. And by generating cash flow out of a relatively simple project, we also start to work at being operational, and our company maturity goes up. I think it was George Patton that said, a good plan violently executed is better than a perfect one tomorrow. And so if you look at kind of the history of what we're doing, thank you. If you look at the history of what we're doing, is we're moving very quickly. We're looking at what are our most simple options, and then how hard can we execute them. And I think if I could leave you with a couple things around that, the reason that we're able to attract such good partners like Glencore, like McMahon, such a strong executive team, and to be able to move so quickly is one, we're in copper, and there's a strong forward view on what that looks like. Two, we're in Western Australia, where the duration of travel, supply chain, the depth that we have, it provides us so much. And then three, the amount of information and accumulated benefit from being a past producer, it doesn't take very much to get people convinced in what we're doing. So what we're playing for, as I said, is that 80 million ton open pit. This is a 20-year reserve tail. There's nothing like this on the ASX. And what this is kind of a $200 million a year EBITDA business. Our PFS says that we would build it at roughly 2 times, or around $400 million. As we stabilize the company in 2025, late 25, early 26, we'll come out with a BFS that has our mining partner deeply embedded in it and start to execute this plan. And ultimately, what you'll see is that companies like this, with this kind of asset package, they're worth $400 million on a pre-production basis. They're worth $1 billion on a post-production basis. So in terms of torque and where we're going from here, just an incredible amount of torque from our $45 million market cap today. Thanks for your time and attention. Please come see me afterwards.